It is Thursday, April 30th, 2026. If you were to glance at a financial terminal today, the numbers would tell you a story of cooling momentum. Silver is trading at $73.63 per ounce. Gold is hovering at $4,121.40. To the casual observer, these figures represent a solid, if somewhat exhausted market. After a meteoric rise from the mid-30s in 2025 to a staggering high of $121 in March, the current price feels like a retreat, a fading echo of a bull run that has finally run out of oxygen. But looking at the price today and assuming you understand the market is like looking at the surface of the ocean and assuming you understand the tectonic plates shifting miles beneath the crust. What I need you to do is stop, put aside the charts for a moment, and pay attention to a convergence of data that most investors have never encountered in their professional lifetimes. We are not looking at a standard market correction. We are witnessing the structural dismantling of a price discovery mechanism that has governed the precious metals market for half a century. Beneath the $73.63 price point, three independent high-velocity signals have just flashed simultaneously. These are not speculative theories. They are three hard data points that, when overlaid, reveal a market that is approaching a violent threshold. This is the moment where the paper reality of the financial world finally collides with the physical reality of the industrial world. And when those two worlds meet, the resolution is never gradual. It is sudden, disorderly, and permanent. The three signals of the threshold. To understand the gravity of this moment, we have to look past the ticker. We are currently standing at the center of a perfect storm driven by three distinct factors. The COMEX structural collapse. For the first time in 12 years, silver's open interest on the COMEX has plummeted below 100,000 contracts. This isn't just a drop in volume. It is a mass exodus of the paper traders who have traditionally managed the price. Even after the exchange cut margin requirements, essentially making it cheaper to stay in the game, the participants kept walking toward the exit. The paper suppression machine is running out of fuel. The corporate treasury pivot. A major technology company specializing in hyperscale AI data centers has just bypassed the digital exchanges and the ETFs. They didn't buy Bitcoin. They didn't buy government bonds. They purchased 10,000 ounces of physical, 999 fine silver to hold as a treasury asset. This is the micro-strategy moment for silver, the first ripple of a wave that will turn silver from a speculative commodity into a strategic boardroom necessity. The exhaustion. Bottom. In the communities of precious metals, investors, the mood isn't one of excitement. It's one of deep, agonizing frustration. People are exhausted. They are discouraged. They're questioning the very foundation of their thesis. Historically, this level of psychological capitulation has never been the sign of a dying market. It is the exact emotional environment that precedes the most explosive upward moves in financial history. The illusion of the shrinking ruler. Why is this happening now? To answer that, we have to address the fundamental why that the mainstream media consistently ignores. We are taught to measure the value of silver in dollars, but the dollar is not a stable unit of measurement. It is a shrinking ruler. Imagine trying to build a house using a ruler that gets 1 inch shorter every single month. By the end of the year, your measurements would look insane. Not because the house has changed, but because your tool for measuring it has decayed. This is the reality of our current monetary environment. When we talk about silver hitting $300, we aren't necessarily predicting that silver will become 4 times more valuable in a vacuum. We are predicting that the currency used to price it is undergoing a structural debasement that cannot be reversed. Silver is the nervous system of the modern world. It is physically embedded in the AI servers that drive our intelligence, the solar panels that drive our energy, and the electric vehicles that drive our transport. Unlike the paper promises traded on Wall Street, you cannot print more silver to satisfy a debt. You cannot algorithm your way out of a physical shortage. The core mystery: why is the system abandoning itself? The real mystery we have to solve today is why the paper market is retreating exactly when the industrial world is screaming for more metal. Why would the COMEX, the very heart of silver price discovery, allow its participation to collapse to levels not seen since the aftermath of the 2008 financial crisis? The answer lies in a failure of trust. For decades, the silver price was managed through a simple mechanism: flood the market with paper contracts that had no physical backing. If the price got too high, you simply increased the supply of paper silver. But today, the ratio has reached a breaking point. For every single ounce of physical silver available for delivery, there are 7 paper claims stacked on top of it. As the physical vaults drain, driven by insatiable industrial demand from the East, the paper traders are realizing that the game of musical chairs is ending, and there are only a fraction of the chairs required for the people still in the room. We are standing at a threshold that does not appear twice in a generation. The suppression mechanism is not just weakened, it is visibly failing. The demand is no longer discretionary, it is operational. And the new category of buyer, the corporate treasurer, has just walked through the door. Over the next 4 parts of this essay, we are going to dismantle the mechanics of this collapse. We will explore how the paper weapon that killed the 2011 rally has been broken, how the tokenization of assets is about to unleash a tsunami of institutional capital, and why the final verdict for silver has nothing to do with the dollar price and everything to do with a generational transfer of wealth. This is not a motivational speech. This is the data. And the data suggests that the silence you hear in the market right now isn't peace. It's the breath before the scream. To understand why the silver market is behaving so erratically in April 2026, we have to look back at the scar tissue of the last great bull run. In financial circles, the year 2011 is whispered about with a mix of reverence and terror. It was the year silver almost broke the ceiling, screaming toward $50 an ounce in a rally that felt unstoppable. At the time, the world was drowning in the liquidity of quantitative easing, and investors, fearful of currency debasement, flocked to silver as the poor man's gold. But as quickly as the peak was reached, the trap was sprung. In just 4 trading days in May 2011, the rally was dismantled. It wasn't a sudden discovery of a massive silver mine or a collapse in industrial demand that killed the move. It was a surgical strike executed through the paper futures market. The CME group raised margin requirements 5 times in a single week, essentially making it too expensive for traders to hold their positions. This triggered a cascade of forced liquidations, a waterfall on the charts that left retail investors holding bags, while the institutional shorts consolidated their power. For 15 years, that event served as the definitive warning, don't bet against the house. The house, in this case, was the COMEX, the global hub for silver price discovery. The paper weapon was the ability to flood the market with unlimited short contracts, promises to deliver silver that didn't actually exist in any vault. As long as the paper market was fat with participants, the house could manipulate the price regardless of physical reality. The structural pivot, why 2026 is categorically different. The ghost of 2011 still haunts the sentiment of today's community, but the structural reality of 2026 has rendered the old playbook obsolete. In 2011, silver was a speculative asset with a niche industrial background. Today, it is the fundamental blood of the global technological infrastructure. The most glaring difference is the state of the weapon itself. In 2011, the paper market was robust, boasting high open interest and high liquidity. Today, that system is in a state of terminal decay. Silver's open interest has collapsed to a 12-year low, dipping below 100,000 contracts. When the COMEX tried to repeat its old trick, cutting margin requirements to entice traders back in, the market didn't bite. They didn't stay. They didn't reload. They kept walking toward the exit. This is the sound of a system losing its credibility. The paper traders, the banks, and the high-frequency algorithms are no longer confident that they can manage the price without being run over by a physical demand wave. The weapon that killed the 2011 rally isn't just weakened, it is structurally compromised. The industrial metamorphosis. While the paper market is shrinking, the physical demand side has undergone a metamorphosis. In 2011, solar photovoltaics accounted for a mere 11% of industrial demand. Silver was a nice-to-have metal in a niche green energy sector. Fast forward to 2026, and that figure has nearly tripled to 29%. Silver is no longer a footnote in the energy sector. It is the cornerstone of the global energy transition. It is physically impossible to build a high-efficiency solar panel, a high-performance electric vehicle, or a hyperscale AI data center without silver. Its thermal and electrical conductivity are peerless. In the world of physics, there is no substitute that doesn't involve a massive trade-off in efficiency. This has created what economists call inelastic demand. If you are an AI data center operator or a solar farm developer, you don't care if silver is $30 or $130. You have a multi-billion-dollar project that cannot be completed without a few 100,000 ounces of metal. You don't have a price threshold where you stop buying. You have a production continuity requirement. You will pay whatever the market demands because the cost of a halted assembly line is infinitely higher than the premium on the silver itself. The west to east drain, a geopolitical handover. Perhaps the most underreported factor in this context is the massive geographical shift in where the world's silver is actually located. For decades, the West, London, and New York held the world's strategic stockpiles. But in early 2026, the west to east drain reached a tipping point. China, recognizing the strategic importance of silver for its dominance in solar and EV manufacturing, has begun importing silver at a record-breaking pace, over 790 tons in the first 2 months of this year alone. But they aren't buying paper contracts on the COMEX. They are pulling physical bars out of Western vaults. This has created a sustained price premium in Shanghai. Silver is consistently more expensive in the East than it is in the West. In any rational market, this would trigger arbitrage, traders buying in New York and selling in Shanghai. But there's a catch. The physical inventories in Western vaults are being depleted so rapidly that there isn't enough metal left to satisfy the arbitrage. We are watching a quiet, relentless handover of a critical industrial resource. The Western paper price is increasingly decoupling from the Eastern physical price. One is a number on a screen managed by dying algorithms. The other is the reality of a global manufacturing superpower securing its future. The new era of scarcity. The context of 2026 is defined by a simple, brutal mathematical reality. The world has entered its 6th consecutive year of a structural silver deficit. We are consuming over 1.1 billion ounces annually, while mine production has stagnated at roughly 840 million ounces. In the past, this gap was filled by recycling and above-ground stocks, the silver held in private hands and government vaults. But those stockpiles are not infinite. You can only empty a vault once. As we look at the frustrated investors of April 2026, we see a group of people who are exhausted by the volatility, yet they are standing on top of the most significant supply-demand imbalance in the history of precious metals. They are haunted by the ghost of 2011, but they are failing to see that the world that created 2011 no longer exists. The house is no longer in control of the game because the players have started taking the chips home with them, and the chips, the physical ounces of silver, are the only thing that can power the future. In Part 3, we will dive into the technical mechanics of this breakdown and explore how a single corporate purchase has just lit the fuse on an entirely new category of demand. To understand the mechanics of the silver market in April 2026, we have to look past the sticker price and peer into the internal wiring of the COMEX, the global clearinghouse that has, for better or worse, served as the arbiter of silver's value for decades. Usually, a financial market is a robust ecosystem of buyers and sellers balanced by the cost of participation. But today, the wiring is smoking. The most critical data point we are tracking is open interest. In simple terms, open interest represents the total number of active futures contracts. The paper promises to deliver or receive silver at a future date. For nearly 2 decades, this number was the foundation of the price management era. It was high, it was stable, and it allowed commercial banks to flood the market with short contracts, selling silver they didn't actually own to keep a lid on prices. But as of this week, silver's open interest has collapsed below 100,000 contracts. This is more than a dip. It is a 12-year low, pushing toward territory we haven't seen since the dark volatility of 2009. What makes this collapse extraordinary, and what should be the lead story in every financial journal, is what happened last Friday. In an effort to stabilize the exodus, the COMEX pulled its primary lever. It cut margin requirements. By making it cheaper to hold a silver contract, they were essentially putting the market on sale for speculators. In any normal cycle, this would spark a surge in participation. But this time, nothing. The paper traders looked at the discount, looked at the exit, and kept walking. This is the mechanics of distrust. Traders aren't leaving because the cost is too high. They are leaving because the system itself is no longer viewed as a credible proxy for the physical metal. They are watching the same math we are, the ratio between the promise and the deliverable. The math of the breaking point, 7-1. At the heart of this mechanical breakdown is a staggering imbalance. In the silver market, there are 2 distinct ledgers, the paper side and the physical side. For years, the paper side was a gargantuan balloon, while the physical side was a small, stable anchor. Today, the registered inventories in COMEX vaults, the actual bars of silver available for physical delivery, are shrinking at a rate that is mathematically unsustainable. While the paper contracts are contracting, the physical metal is being drained into industrial hands. The result is a current ratio of approximately 7 paper claims for every 1 ounce of physical silver in the system. Think of this like a game of musical chairs being played in a massive stadium. For years, there were 100 people and 95 chairs. It was tight, but the music never stopped, so no one really noticed. But now, the stadium is emptying, the lights are flickering, and the players have realized there are 100 people left, but only 14 chairs. Markets built on promises rather than reality do not resolve through a polite, gradual adjustment. They resolve in a disorderly gap. When the holders of those 7 paper claims all decide they want the physical metal at the same time, the price doesn't just go up, the system breaks. This is why the paper traders are fleeing. They don't want to be the ones left holding a piece of paper when the vault doors are finally locked. The corporate treasury signal, from novelty to necessity. While the old paper system is being dismantled, a new mechanism is being built in real time. This is the story of the first mover. A hyperscale artificial intelligence data center company, an entity that sits at the very frontier of the global economy, has just disclosed a purchase of 10,000 ounces of physical silver as a treasury asset. To the mainstream media, this looks like a rounding error. But to a geopolitical analyst, this is the most significant shift in silver demand since the end of the gold standard. To understand why, we have to look at the MicroStrategy parallel. In 2020, putting Bitcoin on a corporate balance sheet was considered an eccentric, high-risk move, but once the first company did it, they established a legal and financial template. They proved it was boardroom acceptable. Once an asset becomes boardroom acceptable, the institutional gravity of peer pressure and career risk takes over. If you're a CFO and you don't have silver on your balance sheet while your competitors are using it to secure their supply chains and protect their purchasing power, you are suddenly the one taking the risk. This AI company isn't just investing. They are securing supply chain continuity. They operate data centers that are silver intensive. By moving silver into their treasury, they are performing a dual function. They are hedging against a currency that is losing its value, and they are ensuring that they have the physical material required to build their next generation of servers. They are treating silver not as a commodity, but as a strategic reserve. The tokenization revolution, removing the friction. The final mechanical piece of this puzzle is the technology that bridges the gap between a 1,000-ounce silver bar and a digital portfolio, tokenization. Historically, the biggest barrier to institutional silver ownership was the friction. Silver is heavy, it's bulky, it requires high security storage, and it requires expensive third-party audits to prove it's actually there. For a pension fund or a sovereign wealth fund, the operational headache of holding physical silver often outweighed the benefits. But in 2026, that friction is being engineered out of the system. We are seeing the rise of audited, vaulted silver represented by digital tokens on a blockchain. One token equals one verified ounce. You can trade it, hold it, or transfer it with the same ease as a stock or a cryptocurrency, but with the backing of a physical asset in a professionally managed vault. This infrastructure is the hose that will carry the water. When you remove the storage barrier, you aren't just making it easier for current investors, you're opening the door to an entirely new category of capital. Family offices, endowments, and insurance companies, entities that manage trillions of dollars, now have a boardroom acceptable way to gain silver exposure without ever touching a bar of metal. The mechanics are clear. The old paper-based suppression system is retreating because it can no longer credibly back its promises. Industrial demand has turned silver into a non-discretionary necessity, and the infrastructure for a massive institutional scale entry is finally online. The stage is set for a revaluation that defies historical norms, because the very ruler we use to measure it, the dollar, is no longer the only thing in the room. In Part 4, we will look at the global ripple effects of this shift and identify the winners and losers in the new silver era. To understand the global consequences of the current silver market, we have to look at the geometry of capital. For decades, the silver market has been a small, contained pond. It was dominated by retail stackers and a handful of commercial banks playing a high-stakes game of paper arbitrage. But as of April 30th, 2026, the pond is being connected to the ocean. The mechanism for this connection is tokenization. As we discussed, the historical barriers to entry for silver, weight, storage, and audit friction have been engineered away by blockchain-verified custody. This is not merely a technical upgrade, it is a geopolitical pivot. By converting physical metal into a digital, boardroom-acceptable asset, we have effectively widened the hose through which global capital flows. But there is a problem of physics. The hose, the infrastructure of silver supply, was never designed to carry the volume of water currently being pumped into it. When a single mid-sized pension fund or a sovereign wealth fund decides to allocate even 0.5% of its portfolio to silver, that single order dwarfs the total daily liquidity of the COMEX. Now, multiply that by thousands of pension funds, endowments, and insurance companies globally. We are witnessing the arrival of an institutional tsunami hitting a market where open interest is at a 12-year low. This is the recipe for a disorderly gap, a period where price discovery stops being a curve and starts being a vertical line. The geopolitical handover, the Shanghai premium. While Western analysts focus on the dollar price, the real story is the east to west drain. In April 2026, the physical silver price in China is running at a sustained, significant premium over the paper price in New York. This isn't a market inefficiency, it's a market verdict. China, the world's manufacturing powerhouse, has recognized that silver is no longer a commodity to be traded, but a strategic resource to be hoarded. Their demand is driven by two simultaneous, non-optional forces. First, the industrial requirement. China produces the vast majority of the world's solar panels and EVs. Their manufacturers are no longer buying silver on a just-in-time basis. They are building strategic stockpiles to ensure production continuity. When the cost of a silver shortage is a shuttered factory and a broken supply chain, the price of the metal becomes irrelevant. Second, the monetary requirement. With the Chinese property market in structural decline and capital controls limiting access to the The Chinese population is fleeing into hard assets. They're converting paper savings into gold and silver at a scale that is effectively vacuuming the physical metal out of Western vaults. Every ounce that moves to Shanghai is an ounce that is no longer available to back a paper contract in New York. This is the great decoupling. The West is losing its ability to set the price because it no longer holds the metal. Winners and losers. In the new regime, in any generational shift of this magnitude, the map of winners and losers is drawn with brutal clarity. The winners. Early corporate adopters, companies like the AI data center firm we discussed, which moved into silver at $73, will be viewed in hindsight as the visionaries. They have secured their supply chains and their balance sheets simultaneously. Unleveraged physical holders, the retail stackers who endured the emotional exhaustion of the last decade. They are the only participants who are not vulnerable to the wipeout wicks of the paper market. Resource-rich nations, countries with primary silver production, Mexico, Peru, and China, find themselves holding the new oil of the technological age. The losers, the paper traders. Those attempting to short the market using the old 2011 playbook are discovering that the weapon is broken. They are being caught in a squeeze where the exit door is too small for the crowd. The margin traders, even those who are long on silver but use high leverage. The road to $300 is not a smooth line. It is a violent staircase. The intraday volatility of 2026 is designed to shake out anyone who doesn't have the stomach or the collateral to hold through a $10 drop in a single afternoon. Late to the game institutions. The pension funds that wait for confirmation at $150 will find that by the time they are cleared to buy, there is no physical metal left at that price. The shrinking ruler and the $300 target. We must return to the concept of the shrinking ruler. When analysts like Matt Pipenberg or David Hunter talk about $300 or $400 silver, the knee-jerk reaction is to call it hyperbole. But this assumes the dollar is a fixed point in the universe. It is not. The dollar price of silver is rising for two reasons. First, the intrinsic demand for the metal is exploding. Second, and more importantly, the currency in which it is priced is being structurally debased. If the dollar loses 50% of its purchasing power, a $150 silver price is simply the old $75 price adjusted for reality. The gold to silver ratio, currently sitting at approximately 63:1, is the compass that reveals the true distance left in this move. Historically, in times of monetary stress or during the peak of precious metal cycles, this ratio has compressed to 31, or even the ancient monetary norm of 15:1. If gold remains at $4,600 and the ratio simply returns to 30.1, a level it has reached twice in living memory, silver becomes a $153 asset. If it touches the historical 15:1 ratio, we are looking at $300 silver. This isn't a prediction. It is simple arithmetic based on the historical relationship between the two metals. The ripple effect of this compression is a massive transfer of wealth from paper promises to tangible reality. The final barrier, fiduciary duty. The final ripple is the shift in the boardroom conversation. We are moving from the era of why would you own silver to the era of why didn't you secure our position? When silver was $25, owning it was a fringe hobby. At $73, it's a headline. At $150, it becomes a fiduciary obligation. Institutional capital is like a supertanker. It takes a long time to turn, but once it starts moving, it carries an unstoppable momentum. The tokenization infrastructure and the corporate treasury precedent are the triggers that have started that turn. What happens next is the squeeze of the century. As institutional capital attempts to squeeze through the tiny door of a physical market that is already being drained by Eastern industrial demand, the concept of price will be replaced by the concept of availability. In the final part of this essay, we will look at the final verdict, the philosophical and strategic conclusion of this cycle. We will discuss why the ultimate exit strategy isn't about selling for dollars, but about trading for the productive assets of the new world. This is the end of the paper era and the beginning of the era of real value. We return to the present moment, Thursday, April 30th, 2026. The screen reads $73.63. For many, this number represents a failure, a retreat from the triple-digit glory of March. But for those who have spent the last hour deconstructing the structural, technical, and psychological architecture of this market, that number is an illusion. It is the last gasp of a pricing system that no longer reflects the reality of the world it claims to measure. The final verdict on the silver market is not a price prediction. It is a recognition of a phase shift. We are moving from an era where silver was a speculative commodity managed by banks to an era where silver is a strategic tier 1 asset, essential to the survival of the digital and industrial age. The divergence we are seeing between a demoralized retail community and an aggressive new class of corporate and Eastern buyers, is the final signature of a generational bottom. The psychological alchemy of the bottom. To understand where we are going, we must first address the frustration mentioned throughout this community. There is a specific type of emotional exhaustion that occurs at the end of a long consolidation. It is the feeling that the setup was a lie, that the manipulation is too strong, and that the breakout will never truly arrive. In the world of professional contrarian investing, this is known as the exhaustion bottom. Bull markets do not launch from a place of excitement or consensus. They launch from a place of silence. They begin the moment the last weak hand, the investor who bought for the wrong reasons or with too much leverage, finally gives up and sells their position to someone with a 10-year horizon. That selling pressure is the very fuel that the next leg higher requires. As the COMEX open interest reaches a 12-year low, we are witnessing the institutional equivalent of that exhaustion. The paper market participants are tapping out, not because the price is too low, but because they can no longer handle the risk of a system where physical metal is no longer reliably available. The discouraging sentiment you feel today is not a warning to leave. It is the statistical signal that the reloading phase of the bull market is complete. The great deception of the nominal price. The most significant cognitive error an investor can make in 2026 is pricing silver in dollars. If you believe silver is expensive at $70 or cheap at $30, you're still operating under the assumption that the dollar is a stable unit of value. It is not. As we have explored, the dollar is a shrinking ruler. When analysts project a target of $300 or $400, they aren't necessarily saying silver will become 4 times more useful. They are saying the currency used to measure it is losing its purchasing power at an accelerating rate. Silver is simply acting as a mirror, reflecting the structural debasement of the global monetary system. The gold to silver ratio remains the only honest compass in this storm. At 63.1, silver is still profoundly undervalued relative to its historical relationship with gold. A return to the 30.1 ratio, which has happened twice in recent history, would put silver at over $150 without gold moving a single cent. A return to the 15.1 historical monetary norm would push it toward $300. This is not hope. It is the mathematical inevitability of a ratio returning to its mean. The wealth is not created by the dollar number going up. It is captured by the ratio compressing. The exit strategy. From paper to productive assets. This brings us to the most critical philosophical shift in this cycle, the exit strategy. The goal of holding physical silver in 2026 is not to eventually sell it for dollars, so you can buy more things priced in dollars. That is a circular trap. If you sell your silver for $300 an ounce, but a loaf of bread costs $50 and a gallon of gas costs $40, you haven't actually gained anything. You have simply run in place while the currency evaporated. The true exit strategy is to trade silver for productive real assets at the peak of the ratio compression. This is how generational wealth is built during a monetary transition. It is about trading 500 ounces of silver for a piece of prime, income-producing farmland that used to cost 5,000 ounces. It is about trading 1,000 ounces for an energy-producing asset or a stake in a manufacturing business that was previously out of reach. The wealth transfer occurs when you move from a hard asset, silver, that has been revalued by the market into a productive asset, land, energy, business, while the rest of the world is still trying to figure out why their paper savings no longer buy what they used to. Silver is the bridge that carries your purchasing power from the old system to the new one. Once you've crossed the bridge, you don't go back to the side that is falling into the abyss. The future outlook, the era of reality. As we look toward the remainder of 2026 and into 2027, the road will not be a smooth upward line. It will be violent. We will see $10 drops followed by $30 gaps. We will see headlines calling silver a bubble one week and a strategic necessity the next. But the underlying reality remains unchanged. The paper shield is broken. The COMEX can no longer suppress the price through unlimited paper contracts because the physical vaults are too thin and the participants have lost trust. Corporate adoption is the new floor. As more tech companies follow the precedent of the first AI data center treasury purchase, the demand for silver will become institutionalized. It will no longer be a retail-driven meme metal. It will be a line item on corporate balance sheets. Physical scarcity is non-negotiable. With a structural deficit entering its 6th year and Eastern demand vacuuming up Western stocks, there is no easy way to increase supply. You cannot print silver into existence. The final thought. The individual holding physical silver on April 30th, 2026 is performing a vital function. You are acting as a self-sovereign central bank. You are holding an asset that requires no one else's promise to be valuable. You are holding a metal that is both the money of kings and the blood of the digital age. The noise of the daily chart is designed to make you blink. It is designed to make you doubt the structural reality that is visible to anyone willing to look at the data. But the data is clear. The paper infrastructure is retreating. The physical demand is accelerating. The corporate world has just begun its pivot. In the end, the price of silver is not just a number on a screen. It is a measurement of the world's return to reality. And in a world built on paper promises, reality is the ultimate premium. Hold the line, watch the ratios, and ignore the shrinking ruler. The destination is no longer a matter of if, but when. And as the structural breakdown of the old system accelerates, when is approaching faster than anyone is prepared for. This is the end of the paper era. Welcome to the era of real value.